What's up, Matrix, and welcome to Matrix. My name is Looney, and I'll be assisting you to get all of your questions and comments through to us. Today, we are assisting you with your Accounting Paper 1 exam guide. All you need to do to get us on social media is follow Matrix, as well as hit us up on our WhatsApp line. The details are on the screen. As always, guys, we've got a fun competition for you, so please do stay tuned to get all of those details. I'm not alone. With me are my favorite sign language interpreter, Nicolene, as well as the awesome teacher, Ashraf. Thank you so much, guys, and over to you.
Well, guys, welcome. You with Ashraf Patel, who's going to ensure that you become an accounting boffin and you are well prepared for your accounting examination. Remember what we've always been saying, don't fear when Ashraf is near. Okay, guys, now let's get into our lesson so we can see exactly what is it that you need to know for paper 1. Accounting, you have 2 papers. Today's emphasis is on paper 1. Let's look at paper 1 and see what are the requirements for paper 1. Firstly, you have 2 hours in which to complete the paper. Now, time management is critical because every question you will notice on your question paper will have the mark allocation with the time allocation. Please try and stick to that time allocation so that you complete all the questions in paper 1. Remember, the paper will be out of 150 marks. Got it? Okay. Now, if you look at the focus of paper 1, you will find that it is heavily based on what? On the company financial statements. So in other words, remember something else. I've always told you this and I'm telling you again. RTFQ. Now you may be wondering what that means. It means read the full question. Why? Because if you read and understand the question, then you will know exactly how to go about answering it. Now, here's another tip for you. You are given 10 minutes of reading time before the official commencement of the paper. During that reading time, make sure that you look at your answer book, right? And in your answer book, it will give you a clear indication of what you need to answer in terms of the questions that are being posed. Now remember something else. Your answer book is designed in such a way that you don't have to do question 1 first. Which law says do 1 first? Nothing. You start where you prefer. If you prefer question 3, then you start with question 3. In that way, if you're working with a question that you au fait with, you build your motivation, you build yourself up, and I'm sure you will then ace that paper. Okay, so having done that, let's go on and see what is it that you can expect in question 1. Remember, my advice to you is that go back and look at the prelim exams of all the various provinces, because that will give you an indication of the types of questions that you can get in paper 1. Okay, so here goes. We have the income statement, remember, also referred to as the statement of comprehensive income, okay? So that's one possible question. Then the second one is what we refer to as the financial position or the balance sheet, right? So that if you can do both the income statement and the balance sheet, then you're ready to go, because it could be an income statement with notes, or a balance sheet with notes, or a combination of part of the income statement and part of the balance sheet. But you need to know all of them. That's important. Then we go into the next one, which is your cash flow statements. Now remember, this is a definite question. And here you need to know all parts of the cash flow statement. In other words, you need to know the notes to the cash flow statement, you need to know the face of the cash flow statement, everything with regards to the cash flow statement is definitely examinable. So this is one definite question that you will definitely find in paper 1. Okay, then you have analysis and interpretation of your financial indicators, and here, remember, you are given a formula sheet, right? But the formula sheet does not have headings. And that is why it is important for you to know your financial indicators. Remember, if you walk into the exam room and you don't know your financial indicators, I can guarantee you, grade 12s, you're working from a position where you're putting yourself in danger. Don't do that. Make sure you know your financial indicators, but we'll talk about them in a later segment where we'll talk specifically about the financial indicators. Okay, now remember, when it comes to your company financial statements, included in the company financial statements, that means while you're doing an income statement or you're doing a financial position, namely the balance sheet, there are adjustments that will come into that question. Part of those adjustments could be your valuation of your fixed assets. In other words, this could also be part of an adjustment. So don't feel that because it's part of paper 2, it cannot be examined in paper 1, right? With all of this, you need to know your corporate governance, right? You also need to know stock valuation. In other words, how are we valuing stock? Because obviously, if you get a stock adjustment, as part of your adjustments, you need to know how to handle that adjustment. And obviously, you can see again, you get the roles of your professional bodies like SAICA, SAIPA, etc. All of that could feature in paper 1 as well. Okay. Right, now it comes to adjustments. Remember, I've always spoken about the big 5. And I'm not referring to the elephant and all its friends. So when it comes to your adjustments, what is important for you to remember is that you're going to be dealing with the big 5, like I alluded to early on. Here we're talking about your accrued income, your deferred income, accrued expenses, prepaid expenses, and obviously your consumable stores on hand. Right, now, when you are doing adjustments, or you're doing an income statement, or you're doing a balance sheet, the first thing that you do is in your trial balance, you go and see under your balance sheet account section if any of these 5 are appearing. Because if they are appearing, it means that the reversal has not been done at the beginning of the financial year. So therefore, before you proceed with the current adjustments, you first need to do your reversals. So please, important, check out for that when you are dealing with, starting with a question, whether it be the income statement, like I said, or the statement of comprehensive income. Let's agree now, we're just going to talk about income statement and balance sheet because you'll know what I'm referring to. Okay. That means you've now checked the trial balance. None of these appear. I can now go ahead and start with my adjustments. Okay, grade 12s, we're now talking about the format of your financial statements. Remember, you have to know your formats. There's no guarantee that the formats would appear in your answer book. So therefore, make sure you know exactly what the income statement looks like, what the face of the balance sheet looks like, and that you know all your notes to your balance sheet. Very, very, very important. Know what goes into each note as well, right? For example, let me just illustrate one example to you so that you know what we're referring to. When you're looking at trade and other receivables, what are we looking at? We're looking at trade debtors, less your provision for bad debts will give you net trade debtors. What do you add to it? You add your accrued income, You add your prepaid expenses, right? You add your deposit on water and electricity. You add SARS income tax if it has a debit balance. Okay, so I've just given you an indication of what goes into trade and other receivables. You need to know each of those notes because you're not sure which note will be asked for in the exams, but you must know every single note. Another tip, very often the examiner does not ask for the notes as a standalone. So therefore, when that is not required, what you do is prepare and show your calculations. Remember, I'm repeating this. Show your calculations because you get part marks being awarded for your calculations. And you do not want to lose out because we want you to ace the accounting exam. Got it? Okay. Let's move on. I've spoken about the notes to the balance sheet already, but once again, let me just add here that make sure that when you are working through your notes to the balance sheet, you know each note and whatever appears in each note is important, right? You will notice when you're doing companies, you will notice if you've worked through past exam papers, ordinary share capital, retained income, those are the popular notes. They feature more often than not. So obviously giving you an indication that concentrate on those, but know everything else. Right? When it comes to your financial indicators, remember early on we said, you cannot walk into an exam room not knowing your financial indicators. Now once again, when we're talking about financial indicators, you will find examiners say, comment on the liquidity of a company. They're not asking you for a specific indicator. They're not giving you any indication. So therefore, you need to know which are your liquidity ratios. For example, let's go through them. We have 6 liquidity ratios. What are they? It's your current ratio, your asset test ratio, your turnover rate of stock, the period for which enough stock is on hand, right? In other words, your stock holding period. Then you have your average debtors collection period, and then you have your average creditors payment period. So those are your liquidity ratios. Know also that if the examiner asks you about gearing, about a loan, immediately it must spring to your mind that they want me to talk about the debt equity ratio. They want me to also talk about the ROTCE. Do you remember that one? And what is that one there? Your return on total capital employed. In other words, what do you do with your ROTCE, right? You're going to compare your ROTCE, that means your return on total capital employed, you're going to compare with your interest rate. Okay? And know for a fact that if your ROTCE is greater than your interest rate, we are referring to that as positive gearing, right? On the other hand, if your interest rate is greater than your return on total capital employed, that is what we refer to as negative gearing. Okay? Keep that in mind. And then obviously, when you're talking about the debt equity ratio, you are referring to the relationship between debt and equity. This will tell you whether the company is highly geared or the company is lowly geared. Here we're talking about the risk factor. It means if you want to take a further loan from the bank, they will look at your debt equity ratio to see whether you are highly geared or whether you are lowly geared. Always keep that in mind. So when it comes to your financial indicators, like I said earlier, yes, you will be given a formula sheet, but on the formula sheet, there are no headings. You need to know which financial indicator is being asked for and also being able to identify. Obviously, the formula sheet makes it easier, but you also know that if you don't know what it means or you don't know how to comment on it, you're going to be asking for a lot of trouble, and we don't want that to happen in the exam. Okay, so know your indicators. Another important indicator that we use is we can work on here, I think. It's your dividend payout rate. Now, you will notice that, again, I'm making a reference to past exam papers. You will be asked a question about the company's policy with regards to the dividend payout policy. So here also, you need to know the indicator, 1. Number 2, be able to comment on it. Number 3, also make a judgment on it. So when dealing with indicators, 1 is to state and work out the indicator. 2, once you've worked it out, you compare it from last year to this year, right? You talk about the trend of the indicator, and also then you finally comment and say why you think the indicator is good or bad. So in this way, you give a comprehensive answer with respect to the question that is being asked. Okay, guys, I think we'll take an ad break and go to Looney, and we'll see you in a jiffy.
Thank you so much, Ashraf. Matrix, we are going to take a very short break. Go get yourself some refreshments, and we'll see you straight after this. Welcome back from the break, guys. If you've just joined us, we are assisting with your exam guides to help prep for the upcoming exams. If you've ever run out of data, then this next competition is just for you. Matrix is bringing you the hashtag WazoWinner competition, where 2 lucky matriculants stand a chance to win 2 gigs of data. Head on over to our Facebook page to get all of the details and enter, guys. Well, enough talking from my side. Over to you, Ashraf.
Thank you, Looney. Can I take part in the competition? Well, we won't answer that one because it will be unfair, isn't it? Okay, let's get back to the accounting in terms of what are you supposed to know in terms of adjustments. I want to start off with an adjustment which creates so much of fear and panic with our grade 12s. But remember, if you structure yourselves, then there's no need to fear. I'm talking about, yes, asset disposal. This one here. Okay, let's just go back there. We go back to asset disposal. Okay, when dealing with asset disposal, it is important that you put in all the information regarding the disposal of an asset. Before we continue, please listen very carefully to what I'm saying now. Asset disposal, whether it features in paper 1 or paper 2, in any section other than the cash flow section, then you need to know which components are you working with. Remember, when you're dealing with the cash flow statement, I'm specific now, please don't misunderstand what I'm saying. When you're dealing with the cash flow statement, you will dispose of the asset at its carrying value. In other words, no profit or loss on sale of asset. However, anywhere else in the curriculum, whether it be paper 1 or paper 2, you need to know all the components with regards to the asset disposal. So, where do you start off from? You start off by firstly telling yourself, let me indicate the information that I have. In other words, I'm taking the information and I know that my cost price is 100,000. our cost price is 100,000, right? So there goes, cost price 100,000. Okay, that's your cost price, got it? Now you bring in your accumulated depreciation, and your accumulated depreciation is 50,000. Right? Now you come to your depreciation. What is it that you need to know about depreciation? Firstly, what method of depreciation is being applied to this particular transaction? In other words, are we using the cost price method of depreciation, or are we using the reducing balance method, namely working with the carrying value? So in both cases, you need to know both of them. Okay, grade 12s? Know how to work out the cost price method and know how to work on the reducing balance method. In the one case with the cost price, obviously you're working with the cost of the asset. And number two, if you're working on the carrying value, then you're using the reducing or the diminishing balance method of depreciation. So those are your two methods of depreciation. Once you have that sorted out, then you go to something that we call art. Okay? Let's go back. Let's just do it on this page here. It'll be easier. When we're using art, what are we referring to here is not a drawing, definitely not. We're not expecting you to draw James or Tiboho for that matter. We want you to use the three components when calculating depreciation. What are they? They are your amount, your rate, and your time. That means the amount that you are working with, the rate of depreciation as a percentage, 10, 15, 20, whatever we may be using, and then the time component. Always something over 12, because we're working with months, right? Always remember, it's something over 12. And once you've identified that, the first part of your problem is solved. Rather, let's say, the first challenge is over. Okay, now, once you've identified your depreciation and you're doing a calculation, and your depreciation works out to 5,000 Rand, obviously these are just figures that I'm using, you're going to be working with figures as per the question. Then the first thing that you do is you add to this 50,000, you add the 5,000 that you calculated there. So obviously this then changes now to 55,000. Okay? And the next step is you take your cost price of 100,000 minus your accumulated depreciation of 55,000 will give you a carrying value of 45,000. Now this carrying value is very, very important. Why? When you are doing note 3 to the balance sheet, namely your fixed asset note, in that fixed asset note, under disposals, you're going to come across an item that says disposals at carrying value. And that's when you're going to use this 45,000 Rand here, your disposal at carrying value. Can you see how important this calculation is for you, right? You next come to the selling price and you sold the asset for 30,000. Okay? Now, before we go into the profit or the loss, let's first look at the sale or the disposal of the asset. There are many ways in which the asset can be disposed of. One, if you sell it for cash, think about this, keep this in mind. You're debiting bank. Why? We're receiving money, so it's a debit to bank. You're crediting the asset disposal account, which is an interim nominal account. Listen carefully, an interim nominal account. Why? Because the purpose of your asset disposal account is to calculate either a profit or a loss on sale of asset. Right, so what we said, if you sell for cash, debit bank, credit asset disposal. Number 2, if you sell on credit, debit debtors control, credit asset disposal. Right? Number 3, if we trade in the particular asset, right? We're trading it, obviously, when we're trading it in, we're trading it on a new vehicle or a new asset. It's a debit to creditors control and a credit to asset disposal. Notice, in each of the transactions that I have discussed with you, you're debiting a particular account. The credit is your constant. You keep on crediting the asset disposal. Is your debit that changes depending on how you are disposing of the asset. For example, if the owner takes it, right? Debit drawings, credit asset disposal, right? And then sometimes you have an insurance claim where the vehicle is insured or the asset is insured, but you haven't received the money. They've acknowledged the claim, but you haven't received the money as yet. Then you will debit insurance claim and credit your asset disposal. Do not confuse this insurance claim with your nominal account insurance. This is an asset account. Why? The insurance company owes you that money. Now remember, this insurance claim would feature under your trade and other receivables because it's an asset account. It's money that is owed to you by the insurance company because obviously your asset was insured. Okay, now we come to this here, and clearly you can see. I want you to actually see this. Did we sell or dispose of the asset for more or less than the carrying value? Okay? Look at it. If my carrying value was 45,000, as you can see here, and my selling price was 30,000, clearly I sold for less than the carrying value. And when you sell for less than the carrying value, then you have made what we call a loss on sale of asset. In other words, we've incurred an expense in the disposal of the asset. We sold it for less than its carrying value. Carrying value also referred to sometimes as the book value. That means the current market value of the asset. Okay? So, what do we learn from this here? If you sell for more than the carrying value, you're making a profit on sale of asset. If you sell for less than the carrying value, you're making a loss on sale of asset. And if you sell at carrying value, for example, if you sold at 45,000, then you are neither making a profit or a loss on sale of asset. Please. So this has given you a clear indication of how you approach a question regarding an asset disposal. Okay, let's move ahead. And here I have an example for you. And I want you to pay particular attention to this example. You are told that the cost price of the asset is 500,000, as you can see, right? You are also told that it has an accumulated depreciation of 480,000. Now, if I asked you to classify, and I said, what type of an account is vehicles or an asset? It's an asset account, right? But by the same token, every asset also has its negative component. In other words, the accumulated depreciation on that particular asset. Now, let me explain it in a very simple way so that we can understand what are we referring to. In this asset that we are dealing with, it cost us initially 500,000. To date, by how much has that asset diminished or decreased in value? It means we've used up, in other words, how much of the asset have we used up already? We've used up 480,000 Rand of that asset already. Clearly you can see that if that is the case, your current market value of this asset is now standing at 20,000 Rand. That's your current value. Where do we get it from? Cost price minus the accumulated depreciation will give me the value at 20,000 Rand. Clear? Okay. Now it looks like a very simple calculation, and it says, calculate the depreciation for the year. How are we writing of depreciation? we are writing off depreciation at 20%, right? Remember we said you want the three components, A, R, T. So the amount, the method we are using is cost. So obviously the amount that we're writing of our depreciation is 500,000. I've got my A component times the R. The rate is 20%, 20 over 100 times my time. I'm working out depreciation for the entire year. That means for 12 months. That gives me my T component, which is 12 over 12. Okay, now, if you do this calculation, and obviously, you can see it's quite a straightforward calculation because the answer that you get here is 100,000. Obviously, if you want to check, you're going to take out your calculator and you're going to work that out. Obviously, in an exam, you're going to use your calculator. Please, another tip, make sure that the calculator that you're using for the exam is the same calculator you've been using the entire year. Why is that? You build a relationship with the calculator. You know where your digits are. You know how to use it. So please make sure that the calculator that you have is one that you au fait with, you know how to use it, and you know exactly where the digits are. Important examination tip. Right, so in this case here, my depreciation worked out to 100,000 Rand. Okay, now, my entry for depreciation obviously is debit depreciation, credit accumulated depreciation. In other words, your accumulated depreciation, this one here, needs to go up. And you can see that in this case here, if I add the 480,000, if I add, let's go back, I know that my cost price was 500,000. My accumulated was 480,000 at the beginning of the financial year. Let me add the 100,000 to this year. And notice now that my accumulated stands at 580,000. Is that possible? Definitely not. Why not? Because an asset cannot have a negative value. You can't say my asset is worth minus so much. If you get this situation, grade 12s, ignore the 100,000 and remember, this is where we talk about the 1 Rand carrying value. In other words, what do? Right, 500, we said 500 minus 480, the initial amount gave me a figure of 20,000. Remember that carrying value we worked out? The maximum depreciation that you can write off on this particular asset for this financial year is a maximum of what? Minus the 1 Rand will give you an amount of 19,999 Rand. In other words, watch this here now. If you add the 480 plus your 19,999 Rand, you are now going to arrive at the total accumulated depreciation of 499,999 Rand, thereby giving you a carrying value of 1 Rand. This is where we use this method in order to arrive at our carrying value of 1 Rand. What do you note from this year? The moment your accumulated depreciation becomes higher than your cost price, ignore that figure, discard it, and then work out the maximum depreciation that you can write off. In this case here, the 1 Rand. I think it's time for a break. We'll go back to Looney, and we'll see you in a jiffy.
Thank you, Ashraf. Guys, let's take a quick break, but before we do, don't forget to send us your questions and comments on our social media platforms, as well as the WhatsApp line. See you straight after this. Welcome back from the break, guys. Don't forget to enter that competition so you can win yourself some data. Let's head straight back to Ashraf.
Thank you, Looney. Guys, back to our adjustments. A very important adjustment. Please stay focused and see exactly how we go about dealing with this particular one. Here we're dealing with the buyback of shares. Right. Okay. Now let's look at a particular question so we know we are focused in terms of what we are looking at. This is the information that you have. You are asked to complete this note, namely the share capital note. All that you are given is your balance at the end of the year, telling you that there are 600,000 shares in issue, as you can see here, right? And the value of those shares is 4,680 Rand. Clear. Now, let's look at what further information we have. We are told that 100,000 shares were issued at a price of 7.26 Rand during the year. This transaction was recorded on the 30th of September 2019. In other words, the sale of the new shares was recorded. Guys, important, very important. So this balance that you see here includes that transaction. It has been recorded. Okay, what else do we know? We are told that 70,000 shares were bought back on the last day of the financial year, and the transaction was recorded. Very, very important. Remember what we said earlier? RTFQ. Read the full question. Okay, right. Now, let's put this into practice now. How are we going to apply this to my note, which I'm supposed to complete, namely the share capital note? Okay. Firstly, we know that we sold more shares, right? And how many shares did we sell? Let's work from this slide here. 100,000 shares. There we go. 100,000 shares. So therefore, we take this here and we say, right, 100,000. Let me erase that. Okay. So we've got 100,000 shares here. We have 100,000 shares that were issued during the year, right? And what are we told? We are told that these shares were sold at, we sold these shares at 7.26 Rand. Immediately I know, take out my calculator, and I say, fine, it's 100,000 shares, that's 123 times 7.26, because that's the value at which we sold those shares, right, will give me a value of 726,000. Okay, so this means, therefore, if we go into our note, we've got this value at 726,000. Okay, now, remember we're working from a position at the end of the year, and we're trying to work backwards to find out the missing figures in terms of what we need for the buyback of our shares. Right, now, you were also told that you bought back some shares. I think they told you the figure as well. I think it was 70,000. Let's just check if our figure is correct. There goes. 70,000 shares. 70,000 shares were bought back. Now, this is where we now have to see and say, right, let me do this in a different color, just so that we can identify the 70,000. Here goes. These shares were bought back, so I put the figure in a bracket. 70,000 shares were bought back, but they're not telling me the price at which those shares were bought back. So, what do? Panic? No. What I do is think, what do I know? I know that at the end of the year, I've got 600,000 shares, and I have the value for those shares, namely 4,680,000. And this is something that must please sink into what is between your ears. What is it? The moment you have a price of your shares at the end of the year, and there's no further issue of shares In other words, no new shares were sold. Your average price does not change. I repeat, the average price does not change. So do we have the average? Yes, we do. Where do we have it? Here goes. Once again, take your calculator. It was 4,680,000, right? Divided by the number of shares, namely 6 Rand, and that will give you the value of your shares, which was 7 Rand 80. Let's do that again. Obviously, you're seeing it here. The division, let's clear the screen. Let's go again. We said 4,680,123 divided by 600,000. And there we go. 780 is the average price of those shares. Understand? Now, what do I need in my share capital? In my share capital note, I need the average price. Please, guys, I'm begging you. In your share capital note, you need the average price of those shares. The price above the average price will go into my retained income note. Count the number of times. I'm repeating this because of its importance. Once again, in my share capital, I put in the average price. Can I calculate the average? Certainly I can. How do I do that? By taking my value at the end of the year, which I just did, 4,680,000, divided by the number of shares in issue, namely 600,000, that will then tell me clearly that the value of those shares was 7 Rand and 80 cents. That's the average price. So obviously, you're going to take your 70,000, right? So the number of shares that we bought back was 70,000 times 7.8, 780, will give me a value of 546,000. Okay, here we go. 546,000 is the value of the shares that we repurchased. Got it? Okay, now that we have this, let's work backwards. Okay, so we got 600,000. Remember, we bought back 70,000 and we sold a further 100,000. So therefore, in terms of your reverse operation, it'll be 600,000 plus the 70, reverse, I'm working upwards, reverse operation, 670 minus 100 will give me 570,000 shares at the beginning of the year. Got it? So what? Remember, check it again. 570 plus 100 will give you 670 minus the 70 will give you your 600,000 at the end of your financial year. So those are your number of shares, right? With the values, we do the same thing. It's your 4,680,000, add 546 minus 726, and obviously that's going to give you the value of your shares at the beginning of the year. Okay, guys, what is important is when you are doing this note here, you need to ascertain which balance is given to you. What information do you have to work from? In other words, if you have the closing balance, then certainly you've got to work upwards. Like you've just seen, we've worked back from the closing balance to the opening balance, right? Be wary in the exams. Very often, they also give you the opening balance. That means these transactions have not been recorded. Keep that in mind. Very often, or sometimes, they give you the difference between two figures, namely your opening balance and your buyback. Guys, please, in all instances, what is important for you to realize is to see which information you have and how do you use that information to arrive at the correct answer, right? So this is what we deal with the buyback of shares. In conclusion with the buyback of shares, remember what I'm saying. Keep in mind that you want the average price, I repeat, you want the average price to work in your ordinary share capital. Note, this is where we use the average price, and the price above the average price is used, or we use that figure in our retained income note. Okay, we're now going to go on to, we've got a few minutes to wrap up. I just want to draw your attention to the following. Don't forget, in other words, remember. Okay? What? Your financial indicators. Remember which ones are liquidity. Remember which ones deal with profitability. Remember which ones deal with return. Remember the gearing indicators. Remember your debt equity ratio. And yes, certainly remember your dividend payout rate. With regards to the dividend payout rate, what you need to know is whether the company have they increased the payout or have they decreased the payout, right? And if they've decreased it, why are they retaining more profits? Two reasons: for future expansion and growth. That means they're retaining profits so that they can have growth and expansion plans in process, or for equalization of dividends. What do we mean by that? By that we mean that in case there's a lean year, in that year they can still keep shareholders happy by taking from the retained income and therefore boosting the dividend for that current year. Grade 12s, we've done a lot in today's show. We want you to focus and remember, aim for the moon. If you don't get there, you definitely will be a shining star, an accounting shining star. Until the next time, be good.
Well then guys, that's the end of the show from us. Thank you so much for tuning in. A big congratulations to all of our competition winners who will be announced on Facebook after the show. Don't forget, we still have more revision for you guys. All you need to do to check out your favorite subject is go on the schedule on www.wazimatrix.co.za. Well then, from me, Looney, Nicolene, and Ashraf, it's thank you and goodbye.